You don't need to risk hundreds of dollars. Risk just $20 per trade, and I'll show you how to avoid the mistakes that cost traders thousands. First, 15 minutes decide your whole day. I lost $500 before I knew this tip. Be careful. Watch this. One move, caught first thing in the morning, off a single setup you can draw on any chart in about 30 seconds. No indicators stacked 10 deep, no secret data feed, just one shape that shows up almost every single session. In gold, in cable, in the DAX, in whatever you like to trade. And here's the part that matters if you're not sitting on a big account. The people who took this, alongside me, weren't risking hundreds a trade. A lot of them were risking 20, 30, 50 quid, and they still got the whole move. Because this isn't about account size. It's about one repeatable, scalable shape you can trade over and over. The promise what you'll be able to do by the end. So here's my promise for the next 20 minutes. By the end of this, you'll be able to look at the opening candle of any session and answer 3 questions in order. Did the market get manipulated? Did it sweep the liquidity? And is it turning back? Get those 3 right, and you've got the highest reward to risk setup I know of. I'm going to hold one detail back until near the end, the exact trigger that stops you getting stopped out, so stay with me for that. I've been trading for a long time now, and long before the big wins I traded this exact shape day in, day out, on tiny size. So don't let anyone tell you that you need a fat account to learn. You need a setup with an edge, the discipline to wait for it, and the patience to let it pay. That's the whole game. Meet the tick, 3 parts, 1 shape. I call this the tick because that's exactly what it draws on the chart, a tick, the little mark you'd put next to a right answer at school. Price drops sharply, digs a low, then snaps back up and runs. Down hard, then up harder. That's a tick. And there are 3 parts to it: the tick itself, the turn, and the target. Get those 3 in the right order, and you're trading. This works long and short, and it works the same in every market: stocks, indices, futures, Forex, crypto, commodities. The mechanics never change, because the thing driving it never changes. It's people getting trapped, and the market coming back to take the other side. Learn it once, use it everywhere. Why the first 15 minutes carries so much weight? Here's why that opening candle matters more than any other bar of the day. When a session opens, all the orders that piled up while the market was quiet get released at once: overnight positioning, pending stops, algos waking up. That flood is what makes the open so violent, and it's exactly the environment where liquidity gets hunted. The rest of the day is calmer. The open is where the trap gets set. For a UK audience, the 2 windows that matter most are the London Open at 8 a.m. and the New York Open at 1:30 p.m. our time. That's when gold, cable, and the indices are at their most aggressive, which is precisely when this pattern prints cleanest. If you can only watch the charts for 1 hour a day, watch one of those opens. That's where the tick lives. Part 1, the tick, reading the opening candle. Start on the 15-minute chart and do nothing until the first candle of the session has fully closed. Let it close completely. That first 15-minute candle is the opening range, and it tells you almost everything you need for the rest of the day. Don't guess, don't front run it, just let the bar finish. Once it closes, mark one price. If that opening candle closes red even by a hair, draw a horizontal line on its lowest point. If it closes green, draw the line across its highest point. Red, mark the low. Green, mark the high. That single line is the level the whole plan hangs on. Now you ask 2 questions about that candle, and only 2. 1. Is it a manipulation candle? 2. Is it a blow-off? If the answer to both is yes, you've got the tick. If either is a no, you leave it alone and wait for another session. That's the filter that keeps you out of the rubbish. The manipulation filter, measuring against the ATR. A manipulation candle is a fast, aggressive, one-way move, the kind you can usually spot with your eyes. Price rips one direction, then rips back before the bar even closes. But when you're not sure, don't rely on a feeling. Measure it. And a tool for that is the average true range. Switch the same asset to the daily chart and add the ATR indicator. No settings to tweak, just add it. It gives you the average distance the market travels in a day. Say gold's daily ATR reads about 60 points. That's your benchmark for a normal day. Some days it runs hotter, some cooler, but it's the yardstick. Here's the rule. Take the opening 15-minute candle and measure its full range, top wick to bottom wick. If that range is bigger than 20% of the daily ATR, it's a manipulation candle. Gold at 60 points? 20% is 12 points. So if that first candle spans more than 12 points top to bottom, it qualifies. Simple maths, done once, and you never have to argue with yourself about it. If the candle spans, say, 17 points against a 12-point threshold, you're well clear that's a genuine manipulation candle, not noise. If it barely limps to 8 points, forget it. The market didn't do anything violent enough. The 20% line keeps you honest, reading the ATR without kidding yourself. One thing about the ATR you have to respect. It's an average, not a ceiling. Some days, the market blows well past it, $1, $2, more on gold. And some days, it barely moves. Don't treat it as a hard wall. Treat it as the baseline expectation. The 20% figure isn't magic either. It's a threshold that reliably separates a real, violent, open from ordinary chop. Practical tip: if the daily ATR is unusually small at dead, the low volatility session, the whole setup gets weaker, because there's simply less range to trap people and less room to travel back. On those days, be pickier or sit on your hands. A big part of this game is knowing when the conditions aren't there and having the discipline to do nothing. The blow-off when a sweep becomes a signal. Now, the second question, and this is where the tick beats the average opening range play. A manipulation candle on its own isn't enough. It has to also be a blow-off. Meaning, that aggressive candle has to plow straight through the low of the day or the high of the day and then reject. It has to take the liquidity. Picture what's actually happening under the surface. Traders who chased the early strength are now watching their profit and loss bleed red faster and faster. We've all been there. You start smacking the keyboard. Get me out. Get me out. And every one of those panic exits fires as a market sell. That selling feeds on itself and exaggerates the candle. And the institutions know exactly where the retail stops are sitting. If you were taught to buy and place your stop under the low of the day, or short and place it above the high, congratulations, that's where everyone's stop is. That's a pool of liquidity. So price gets pushed just far enough to trigger that cluster. Those stops convert to market orders. The move overshoots for a second, and then it snaps straight back. That snapback is the tell. So the confirmation is dead simple. Price took out the low, it did not keep going, and it turned back up. Anytime something blows through the low and reclaims it, or blows through the high and reverses, you've just watched a manipulation and a blow-off happen together. That's the tick complete. Now we hunt the entry. This is the exact opposite of what most people do at the open. The crowd chases the first strong move and buys the breakout, which is how they end up being the liquidity that gets swept. You're doing the reverse. You let them chase, you let the sweep trap them, and you come in as it reverses. Same candle, opposite side of the trade, completely different outcome. Quick check-in. If this is landing so far, a like genuinely helps the channel get in front of more traders. That's the whole deal. No hard sell. Right, the setup's confirmed. Let's find the exact entry. And this is where that detail I promised comes in. The one that stops you getting stopped out. Part 2. The turn. Dropping to the 5-minute. Now drop from the 15-minute down to a smaller time frame. I like the 5-minute. You can use the 3, the 10, whatever, as long as it's below an hour. All you're looking for here is one thing, a double test of that sweep. Not price rocketing off the low in a straight line. You want it to come back down and re-tap the base of that wick. Why do you want the second dip? Because if that retest gets bought back up, the buyer has just proven themselves twice. It reconfirms the sweep was real and the low is defended. Without it, price could keep leaking lower and lower. The double test is your proof that the floor is holding. Patience here is the edge. Most people miss the trade by front-running this. Part 3, the mark, your exact entry. Here's the trigger, the detail I held back. You do not enter on the sweep, and you do not enter on hope. You enter when one candle closes above the top of the candle before it. One green bar taking out the high of the prior bar, right after that double test. That candle over candle close is the mark. That's your go. Sometimes this happens off a single candle. Sometimes you'll wait 6, 7, 8 bars, occasionally the better part of an hour, for the buyer to line up. That's fine. The wait is the filter. When you finally get that candle closing over the prior one, with the low already double tested underneath you, that's the highest probability version of this entry. The stop, why you stop getting stopped out. Your stop goes just under that swept low the wick the buyer already defended. And this is the whole psychological unlock. If that floor has been tested 2 or 3 times over 15 minutes and held every time, how likely is price to come back and break it now? You're not hoping the low holds. You've watched it hold repeatedly before you risked a penny. That's how you keep risk tiny. Grab 100 shares or a micro lot, and the distance from entry to stop might be a fistful of points 20-30 quid of risk. Because the stop is so tight and the low is so well defended, you can size sensibly and still keep the loss trivial if you're wrong. Tight stop, defended level, small risk, that's the trifecta. The target where the range takes you. Now, the reward, and this is why the tick is worth waiting for. When a market gets manipulated and blown off like that, the natural pull is back into the day's range. So the first, cleaner target is simply the high of the day, the top of that opening candle. 9 times out of 10, the market wants to travel back to reclaim it. Want to be more aggressive? Measure roughly 90% of the daily ATR up from your entry and use that as target 2. If gold's ATR is 60 points, that's a run of about 50 plus points back into the range from where you got in. Because the reward is so lopsided against a tiny stop, you don't need every trade to win. That asymmetry is the whole point. It takes the pressure off. The short side, the same tick, upside down. Everything I've shown you flips perfectly for shorts. If the opening candle closes green, you line its high instead of its low. Then you're waiting for a manipulation candle that plows through the high of the day, traps the breakout buyers, and rejects back down. Same ATR maths, same 20% filter, just at the top instead of the bottom. Then you drop to the 5-minute, wait for the double test of that high, and short when a candle closes below the prior candle's low. Stop just above the swept high, target back down into the range, or the low of the day. It's the identical shape reflected in a mirror, an upside-down tick. Once you can trade one direction, you can trade both. The maths that makes small accounts work. Let's put real numbers on why this suits a small account. Say your stop is 15 points on gold, and your target is the high of the day, 75 points away. That's a 5-to-1 trade. Risk 50 pounds, and you're playing for 250. Win that once, and you can be wrong on the next 3 attempts and still be flat. That's the cushion. Asymmetry buys you. This is the exact reason you don't need a huge balance to start. With a setup this lopsided, your win rate can be modest and your account still grows, because your winners are multiples of your losers. Most blown accounts aren't killed by a bad strategy. They're killed by risking too much on setups with poor reward. Fix the reward, and you've fixed most of the problem, and it scales cleanly. The same 15-point stop, that's £50 on a small account, is 500 on a bigger one. The setup is identical, only the position size changes. So you learn it on tiny risk, build the reps and the confidence, and turn the size up gradually as your track record earns it, never the other way round. Worked example 1 gold/USD. Let's walk one through on gold. First candle of the session closes red, so we drop a line on its low, straight to the daily. ATR is about 60 points, so our manipulation threshold is 12. We measure that opening candle top to bottom, it spans 17, bigger than 12, so it's a manipulation candle. Tick 1 done. Did it blow through the low? Yes, it dipped just under the prior low and rejected. Classic sweep. Now to the 5-minute. Price comes back and taps the base of that wick, the double test, and holds. A couple of bars later, a green candle closes over the one before it. That's the mark. We buy, stop just under the swept low, and target the top of the range. Textbook tick. Managing it is calm. Once price is moving your way, a lot of traders take partial profit as it reclaims the halfway point of the opening candle, then trail the rest toward the high of the day. If it stalls before target, that's fine. You booked most of the move with almost no risk. You do not need to squeeze the last point out of every trade to make this work. Worked example 2 GBP/USD cable. Cable behaves the same way. You just work in pips. Suppose the daily ATR on GBP/USD is around 90 pips. 20% of that is 18 pips. First 15-minute candle closes red, and its full range is 26 pips, comfortably over 18. So it's a manipulation candle. Notice the maths is identical, only the units change. It sweeps the session low by a couple of pips and snaps back. There's your blow-off. Drop to the 5-minute. Wait for the wick to be retested and held, then take the candle that closes over the prior one. Stop a pip or two beneath the swept low. Target the return into the range, ideally the high of the session. Same shape, different market, that's the beauty of it. Worked. Example 3. The DAX. GER 40. Indices are a favorite for this, because the open is so violent. Take the DAX. Say its daily ATR is around 200 points, so your threshold is 40. The opening candle plunges and spans 60+ points. Manipulation candle easily. It drives through the low, traps the early sellers who are shorting the breakdown, and rejects. Blow-off confirmed. On the 5-minute, the low gets tapped twice and holds. A candle closes back over the prior high, and you're in stop under that swept low, targeting the range back to the high of the day, maybe 200 points of room. Same 3 questions, same 3 parts. Once you see it once, you can't unsee it. A clean tick versus a messy one. Not every tick is worth taking, so let me show you the difference. A clean one is obvious. A sharp, decisive sweep that clears the low by a small margin and rejects immediately. Then a tidy double test that holds. Then a strong candle over candle close. Everything is crisp and the buyer shows up fast. Those are the ones you back with size. A messy one warns you. The sweep is shallow and hesitant. The low gets tested 5 or 6 times without conviction, and the reclaim is weak and slow. When the buyer keeps having to defend and price just grinds sideways at the low, that's not strength, it's indecision, and it often breaks down. When in doubt, size smaller or pass entirely. There's always another open tomorrow. The 3 mistakes that kill this setup. Mistake 1. Entering on the sweep instead of the trigger. The sweep is bait. If you buy it, you're the liquidity. Wait for the double test and the candle over candle close. Mistake 2. Skipping the ATR check and calling every wobble a manipulation candle. If it doesn't clear 20% of the daily range, it isn't one, full stop. Mistake 3. Moving your stop or bailing at the first retest. The whole edge is that the low has already been defended. If you jump out, the moment price wobbles back toward it, you hand away the exact trade the setup was built to catch. Set the stop under the swept low, then leave it alone and let the range do the work. Your drill for this week. Here's your homework, and it costs nothing. For the next 5 sessions, no live trades, just mark up the opening candle of your favorite pair. Line on the high or low, ATR check for the 20%, then flag whether it's swept and rejected. Tag each one a valid tick or not. Do that 20 times and you'll spot the shape in a heartbeat, with real money on the line. Keep a simple log. Date, pair, was it a valid tick, and what happened next. You're not trying to be right on every call. You're training your eye to recognize the pattern, and just as important, to reject the fakes. After a week of this, the setup stops being something you read about and starts being something you see. The mindset that ties it together. One last thing, and it matters more than any level on the chart. Trade this like a sniper, not a machine gun. You are not trying to catch every move, you are waiting for one clean tick, taking it well, and being done. One high-quality trade off the London or New York Open is a good day. The traders who blow up are the ones who force setups out of boredom. The ones who last are ruthless about only taking the clean ones. The whole thing in 5 lines. Let's lock it in. 1. Let the first 15-minute candle close and line its low if red, its high if green. 2. Confirm it's a manipulation candle range bigger than 20% of the daily ATR. 3. Confirm it's a blow-off. It swept the low or high and rejected. 4. Drop to the 5-minute, wait for the double test, and enter when a candle closes over the prior one. 5. Stop under the swept low, target back into the range. That's the tick. 1 shape, 3 parts, tiny risk, range size reward, and it prints in almost every market, almost every session. Trade it small until you trust it, then scale it as your confidence grows. The setup doesn't change, only your size does. Close and CTA. If this gave you one thing you can actually use tomorrow morning, subscribe and turn on the bell. The next breakdown drops next week, and I'll be walking through how I manage these trades once I'm in profit, including where I take partials. Drop a comment telling me which market you'll test the tick on first: gold, cable, or the DAX. Risk disclaimer. I read them. Quick and important. This is education, not financial advice. Trading carries real risk, and you can lose money. Manage your risk 1 to 2% per trade and never risk money you can't afford to lose. Test everything on a demo before you go live. Look after your account, and it'll be there to trade tomorrow.